Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the June 20th, 2023 podcast. We have another exciting episode for you today. We're covering a topic that affects virtually any tax credit development: the importance of periodically updating financial models. While updating financial models has always been important, current economic conditions make it much more crucial to increase the frequency of updating financial models. Now, today, we're going to talk specifically about budgeting and modeling for historic tax credit developments, but the discussion equally applies to new markets tax credits, low-income housing tax credits, renewable energy tax credits, and also opportunity zones. Now, we at Novogradac have been receiving a growing number of requests from historic tax credit developers, syndicators, investors, and lenders to more frequently update financial models for their historic tax credit rehabilitation projects. Now, for some of our clients, we're providing quarterly updates because economic and market conditions are changing so rapidly. In today's podcast, we're going to talk about some of the reasons why we're seeing this demand for more frequent updates to financial models. Various parties in the transaction request updated models for different reasons. For example, during the construction or rehabilitation phase, a construction lender may require an updated financial model before they fund a draw request. In this situation, the construction lender wants the updated model to revisit whether the developer, after updating their assumptions, has adequate sources to fund the projected uses during the development of the property. In that sense, you get through a few construction loan draws, and then the construction lender is saying, okay, there's been a number of changes in the market. We want to ensure the project has sufficient sources projected to fund the projected uses. Now, unfortunately, more often than not, this exercise does reveal that a financing gap has arisen since the prior set of projections. Now, the good news is that by identifying the gap early, there are steps the developer can take to close the gap. And my guest on the podcast today will discuss some of those steps. And we also see developers updating their financial models when it appears the amount of tax credits that they're going to generate is materially changing. Or I should say, when the delivery of those credits is likely to be delayed or be accelerated. That does happen. The updated models are then used by the developer to discuss these changes in tax credit amount and delivery with their syndicator and or investor, and then potentially amend the partnership agreement and other documents, such as the developer fee agreement, prime lease, and the like, to adjust the agreements and the arrangements that they have with their investor. Now, in addition to talking about why updated financial models are important, we'll also discuss some of the specific development costs that we most often see change in the current economic environment, as well as some of the unexpected situations that can arise that can cause delays in tax credit delivery. So you're probably wondering, who's my guest today? Well, my guest today is my partner, Dave Graff. Dave is based in Novogradac's Cleveland office. Dave is highly experienced helping developer clients review their budgets, initially prepare and update financial models, as well as conduct final cost certifications. Dave has extensive experience helping clients navigate financing issues, so I'm super excited to have him share his insights with you, our listeners, today. If you're ready, let's get started. Dave, welcome to Tax Credit Tuesday. I think this is your inaugural podcast.
Thanks, Mike. Yeah, you are correct. This is the first timer for me, so I'm looking forward to having a fruitful discussion.
Well, thank you for making time to join us on the podcast today, and I look forward to having you back on future podcasts. Now, preparing for the podcast, you mentioned that you're seeing a growing number of developers requesting more frequent updates to their financial models, and specifically for their historic tax credit projects. But I know that we're also seeing this in local housing tax credits, new markets, renewable energy, and opportunity zones and the like. What do you see as some of the factors that are leading to this increased frequency in updating financial models?
Yeah, no, I think it's a great question. And I like how you kind of mentioned that this is not the only industry that's kind of encountering this. I know this is a routine exercise for renewable, updating ITCs. It's, different reason, but same goal. But going back to the historics, yeah, this is definitely various reasons. The ones off the top of my head that I can, or primary would be delaying construction timelines, rising costs for construction, inflationary reasons for maybe that's impacting your NOI and need to, maybe your NOI was already tight and now it's maybe even tighter, unplanned change orders, and obviously interest rate volatility, which we all know is pretty excessive at the moment. Unfortunately, developers may be encountering one or more of these at the same time, and that's, I think, even more of a reason why this exercise is especially critical to assess. A lot of these situations are beyond a sponsor's control, and so for the sponsor, updating what they can control is step one, and then obviously planning for things they can't control is step two. And so it's critical that they keep going through this, and just getting through closing is an accomplishment. But that's not the end goal, right? The end goal is to have this property and the end have a successful project. So in doing that, it's a constant monitoring, constant nurturing of this project, and the financial model can be a tool to assist in that endeavor.
So thank you for that, Dave. And mentioning that reminds me, a number of months ago, I wrote a Washington Wire on all the dynamic changes that inflation's causing for locally test rate properties. And I talked about the impact of inflation and the rest on the uses, and that's kind of pretty sort of direct. And then also the impact inflation can have on a variety of the sources. When I think about the overall kind of budgeting of sources and uses, and then I also wrote about the impact of inflation on income levels, on the income of the property going to generate over time, along with the operating expenses, which, as you know, it all becomes sort of circular because you have the uses, the sources, then you end up having the gross income it's going to generate over time, operating expenses, which generates a net operating income. And then depending upon the change in net operating income, that goes back and affects the sources. And it's all sort of a bit iterative. But I'll post a link to that article in today's show notes for our listeners. And it provides a bit of a paradigm to think about a financial model in the various sub pieces of the financial model that Dave and I'll be touching upon today. But I think the article does a good job of breaking them out into sections. So Dave, I did want you to share with our listeners, what some of the major benefits for developers, lenders, and the others of these more frequent updates to financial models.
Sure. Yeah. And I think I'll start off with developers here because I think obviously they're the catalyst of this whole thing. They're the ones that are kind of going through this in the trenches. And so, that time period from closing until placed in service and beyond, there's a lot of uncertainty in that time period, especially with these things we've discussed as in the environment. The most important item is just identifying potential sourcing gaps, especially if you have variable rate debt. I mean, I've seen some pretty sizable interest rates at this point, and it's having a major impact on cash flow. So there's budgetary concerns, but there's also cash flow concerns. And I think a lender, an investor, a syndicator, they're all going to have different concerns. And how do we formulate a solution for one or all of those problems? So with identifying potential sourcing gaps, obviously there's contingencies that are kind of contemplated up front, and usually it's a percentage of your overall hard cost. But, 12 months ago, that might have been a different number. And now labor shortages are driving up labor pricing. It doesn't take much for one project to go over budget. And I think we can all attest that projects going over budget is the expectation, but you have to be able to have a contingency plan if that ends up being the case. The revised forecast can help pinpoint, earlier in this process that, hey, we're going to have maybe $1 million shortfall. What are we going to use to rectify that situation? Are we going to potentially go and talk to the lenders we're already working with, getting a new lender potentially involved? There's maybe a co-sponsor who is in it maybe for more of the cash return. So they may be looking at it from a different angle. I know you and I kind of briefly discussed value engineering, kind of preparing for the podcast a little bit, finding areas of your project where you can reduce costs but still maximize value, change orders, working through those that maybe are unforeseen, deferring additional developer fees, also a potential avenue, or reducing the fee in general. Because at the end of the day, that could be viewed as, well, you're paying yourself back. Here's just a reduction of this cost. That way we don't have to front that capital up on day one. So there's many different ways that a sponsor can view this, but ultimately it comes down to what's going to be the best solution and the lowest cost of capital to achieve that solution. And the sooner you have that, a year in advance or 6 months in advance and not 3 months, or you give yourself kind of a timeline. We all know how long it takes to close a historic transaction. So, that won't be any different if you try to introduce a new source down the road. Another factor is, HTC installments obviously are tied to, usually 3 or 4 installments. There's a closing, and then you may not see HTC capital until placed in service date. And so that tax equity you're kind of banking on down the road is likely not going to be the solution you're looking for. Bridge financing potentially, but at the end of the day, that's going to get paid back with the sources from tax credits. So there's going to be a tangible need for sourcing. And, you know, adjusters do come into play, especially if you are going over budget. And most, if not all operating agreements will address this. The question is, well, how much of an adjuster is there? I've seen anywhere from 10 to even 25%. Obviously, the higher you can go, the better for your development, but that's not always the case. And so if you have the ability to plan ahead and you're going to run into some construction cost overruns, you can have that conversation sooner with your investor and say, like, look, here's where we are. Here's the reasons why we're going over budget. Can we modify our arrangement, or is there a way around we can come to an agreement that, this additional cost will be resulting in additional equity? And I think that, coming back to the focus of our discussion here, that revised model will be the best piece of information to show that investor, because it's the deal they saw when they closed it. Them being able to compare apples to apples will make that process much smoother. And also having Novogradac involved, working through that process, is going to add a little bit of vetting to that arrangement.
I obviously agree with everything that you're saying. And the one thing I always think about with the financial model, and we talked about a little bit this when we were preparing for the podcast, that there is definitely a tendency, even myself, to think, okay, I know I know of a few changes that have happened since the last model, and now in mind, maybe I can project what the consequences of that change are. And then when you actually think, okay, now I'm going to spend the time to update the financial model, you look at it and say, well, I had this additional cost overrun. Maybe now but I also had, a certain amount of contingency. So maybe my contingency just isn't as much now. And then I go and I look on the tax credit side and say, well, now that I have these higher costs, some portion of them fit in qualifying rehabilitation expenditures such that I'll get some more tax credits. And as a consequence, I should get more sort of tax credit equity. But then, as you point out, I then have to make sure that the adjusters and all the rest, the investor is eligible for that. It is there is going to buy those additional or invest additional equity for those additional tax credits. And then while I'm doing that, I think, okay, I'll revisit my operating income expenses, and maybe it's a affordable housing transaction. I'll see low housing tax credits involved potentially, and the new income numbers that come out. So now I can adjust my income projections based upon the new income numbers. And there's all these various variables. And when you toss them all in, a lot of times the results in terms of financial gaps and the rest aren't necessarily what your gut tells you. So it's really an exercise that, is when you go through all those different steps, you can quantify more accurately, what the difference is. And as you point out, then you can start focusing on how to solve that gap issue. And as we also discussed for the podcast, sometimes it's a net positive and you actually have, a little bit more sources than uses. So maybe you have less deferred developer fee and the rest. That's not usually the case, but it is sometimes the case. It might even influence your view on change orders and things of that nature. There might be parts of the development that, you would like to change or enhance, but you end up looking at it on balance and you feel like you don't have the money. So there's a lot of ways in which the model can affect your behavior and the judgment that you're making.
Yeah. And I will add one thing, when you're kind of going through that and identifying that there is a source gap there, it's highly likely that your lender is going to require you to kind of front that source before they put additional funds in, right? And so knowing that in advance and kind of maybe projecting out, okay, well, what do we need to put in now so that 6 months from now we're in a much better shape? They may say, hey, we need that equity in now. And so running through these exercises will help quantify that.
And I do know we've seen some where, you end up bringing in the additional equity investor that's just there for the cash flow. There's a number of ways in which developers can respond to these situations. But obviously you can't respond to what you don't know.
Right.
I liked your point about, there might need to be more equity, et cetera. It might be one of those things where if you wait 6 months and then it gets revealed, and then you're gonna have delays in construction loan draw requests or delays in your equity contributions and the rest. And then you're in a sort of a cash bind without much time to address it. So it's always, as I always sort of say in the accounting business, you're always better off identifying any issues earlier than later, because the earlier in the process you identify it, the more options you have to solve it. So I know as part of updating the financial models for your developer clients, I know that you often also provide a more detailed review of their construction budgets. And I was wondering if you could share, not I was wondering, I'm asking you to, could you share some common errors or misconceptions that you find when you're doing a more detailed review of a developer's construction budget?
Sure. Yeah, I think obviously the discussion to have up front, it's great to kind of walk through those assumptions. Every developer may have their own education or understanding of what a QRE is and how it may impact their transaction. But as far as kind of common errors and misconceptions, I think a lot of times we see maybe too broad of categories of line items, whether it's a construction contract itself, may just say hard cost. And it's okay. Well, what are those components of hard cost? What might be included in that? Is there exterior site work that's included? You know, I think broad categories, obviously accountants love detail. We routinely will go through those, even if it's a 30-page line item. I mean, at least you have it itemized and you have your best case estimate of, where you think you're going to fall. And if that modifies or gets changed, you can quickly identify which line items those were and say, look, this was an eligible item. We think it's still fine. It's not something new that's being introduced or being uncovered later down the road that came as a surprise. One of the things that I would stress too is understanding, like, let's say you have a rooftop addition or an enlargement, items like those, being able to quantify that, they might be in the hard cost line item in total, but understanding the project, and that's kind of our job too, is to understand the development itself and what's expected to be rehabilitated. Understanding that relationship and where the plan is heading on the architecture side. Is there any new enlargements? Those are all factors we want to get an understanding of and how it may be applicable to the budget that the developers provided. Some other areas of concern that we've seen are, you know, following the term sheet, like debt term sheets, and reserve requirements are a big item. Obviously, those can be very substantial, especially in an interest rate environment that we're in now. They can be 3 to 6 months of OpEx, and when you calculate what that might be for, let's say, a hotel, that can be pretty substantial and a very large nut to crack on day one, because a lot of times that's required at closing. So working through those term sheets and then identifying all the costs of that capital and accounting for that in the forecast is critical, especially knowing the draw terms. Is it funded up front or is it funded net? Those are could be big swings in how much interest you incur on a project if it's funded up front entirely at closing. You're incurring interest on all those dollars. And then as far as kind of the construction timeline, just understanding when equity is supposed to come in. What's the benchmark? Obviously closing, that's pretty easy to follow, but, understanding the C of O requirements for the second installment or third installment, you could have other deliverables such as an audit or tax return required. Most certainly you're going to find that a cost certification is required. Those are deliverables that, obviously have their own lead time. And so understanding that, just because you placed it in service in, let's say, November, doesn't necessarily mean you're going to get your HTC installment on December 1st. So planning ahead for those lead times is crucial.
And I would just note that I did do a podcast many moons ago with our partner, Tom Boscia. It was dealing with term sheets for historic tax credit transactions. We discussed a lot of those sorts of issues about having the initial term sheet, having agreement, what the conditions were, and the rest. So you're mindful of just what you said. If one of the conditions is placed in service, but also a tax return showing the credits, that can have a notable impact on when you actually get the cash for the equity contribution. So being mindful of those during the term sheet phase. Then I'll include a link to in the show notes to that, but being mindful of it at the time you're doing the term sheet, but then obviously then when you're updating your projection, the rest, to keep all of that in mind. So,
Yeah.
mhm.
Sorry.
No, please go ahead.
I was just going to also add, when we talk about potential delays in credit delivery, right? And let's say that place in service date slips from Q4 to Q1, that could even have a larger impact because maybe a deliverable is an audit or a tax return. And now you got to wait potentially another full year to see that equity. So keeping that placed in service date in mind is always a critical concern for developers.
So a lot of what you talked about on this response to the last question had to do with you're getting kind of more detail, more information about what's in the various budgeted line items and the rest, so that forecast itself can more accurately estimate qualified rehabilitation expenditures or QREs. So you more accurately estimate the amount of historic cash credits can be generated, as well as from a timeline perspective, understanding when different installments going to come in and the rest. And obviously you got to make sure you got enough cash flow during the development process, during the construction phase, and then ultimately, when you can start getting paid some of your developer fee. So, but beyond looking at those, like the categorization, the timeline, and the rest, I was wondering on the actual cost side, what types of costs are you seeing coming in over budget? That when you look at maybe the initial set of projections, there's a certain estimate for certain costs, but you're finding now that those particular categories are a lot higher than original estimates.
Yeah, I think the number one answer there is for sure is hard costs, your construction contract. That's going to be the one that can probably fluctuate the most just because it's the majority of your budget, and a 10% swing in that budget alone can have a pretty substantial effect on sourcing. And then obviously later on, the calculation of HTC equity, like we said, we talked about already with adjusters, it kind of has a domino effect. And,
Yes.
you know, knowing that up front is sometimes out of your control and no one has a crystal ball, but the reacting to it and planning as well in advance as you can is going to be critical. But aside from hard costs, I mean, it's, reserves are usually kind of upfront and set aside, and those are more, I guess, known. But
Right.
the longer that construction phase plans out, there may be requirements to say that, look, at no point our reserve can drop below 6 months. And, we've extended the construction timeline by 6 to 12 months potentially. At that point, even though that reserve might not be the item that's over budget, you had to put in equity to keep it where it was.
Right.
They may not let you deplete it entirely. And so those are key things too to keep in mind is those reserve dollars may not always just be exactly we get the money back if there's anything left over. There may be some strings attached or some requirements of the developer to refund those initial dollars.
So you mentioned here when we were talking about getting more detail on costs and the like, so that if there's, enlargement costs that aren't eligible expenditures for historic tax credits, enlargement costs that you identify them. You don't identify them in the cost certification phase. You want to identify them sort of up front. And you mentioned furniture and fixtures, which also aren't tax credit eligible or historic tax credit eligible, because of course, the historic tax credits are about, reserving the historic integrity of the building or bringing it back, not buying furniture and fixtures. So those costs aren't eligible. But rather than talk just about the costs that aren't eligible, what types of qualified rehabilitating expenditures, what types of costs are eligible to calculate your 20% tax credit that you find developers will overlook?
Yeah, I think that's a good question because, soft costs are, you know, although they may not be the majority of the budget, they add up quickly. And when you think about all the attorneys involved and the closing costs, property taxes and insurance, carrying costs you have on the property throughout the construction period, those all need analyzed. And the good thing is that the majority of them can be capitalized during that time. Soft costs that pertain to professional fees need a little bit more of a lens applied to them. And oftentimes we reach out to tax attorneys and the council to kind of get their viewpoint on, hey, where did you spend the majority of your services? And we kind of get some of their feedback. And we have a pretty good track record of just working with them and can generally guide developers and sponsors and the way that we think like, hey, we assume this was maybe going to be about a 20%, just as an estimate, whereas maybe they were at 0 or maybe on the other side of it as 100. So it's kind of just seeing what that initial budget is and making sure that even those costs are even accounted for, right? And understanding how much closing costs can be. Those can be hard to predict, but I think that's step one is identifying the cost itself. And then step two is what's the tax implication of that cost? So I would say soft costs are critical, developer fees, sure. Some other items that can be potentially overlooked. Most developers are going to be a little aggressive on the developer fee side, but working through that and obviously our constituents over and their colleagues over in the GoVal group that Novogradac has, kind of understanding how to maximize that developer fee to the extent it makes economic sense and that it is deemed reasonable. Obviously, that's the critical item there that sponsors need to be aware of, but developer fees have some room. Obviously, if your construction budget is increasing, there may be some room to kind of, you know, commensurately increase that developer fee because you're obviously they're putting more effort in. You're having to manage more items that are going on during the construction phase. There's potential there that you can increase the fee that the developer is earning.
Thank you, Dave. So it's clearly important to have an experienced historic tax credit consultant like yourself involved as early in the development process as possible. And I know when I was talking to Tom Bosch, I was like, well, when should the historic tax credit, accountant be involved? And it's like from the very beginning, even if you can, before you create your first pro forma internally. But with your experience and expertise, I know that you help clients ensure that they have a more comprehensive financial model as that starting point. Also, I would just note, as we're discussing, there are many variables that do change over that 12, 24-month construction lease-up period, which is why we've been talking about frequently updating models. So as we think about the initial comprehensive model, the updates during the course of the development and construction lease-up phase, I thought maybe you could share with the listeners, beyond hard costs rising because of inflation, what other areas, when you think about the financial model, are some of the generating some of the greatest changes? And I know there's a lot and all the rest, so maybe just a handful. And maybe to frame it a little bit better, we have the initial estimates of construction costs and other development costs. We know that hard costs can be rising because of, or are rising because of inflation as a general matter. Then there are sources, the various projected sources, tax credit equity, permanent loan financing, interim construction loan financing, deferred developer fees, other, gap financing. It could be equity for state credits. It could be other sources. And then from a permanent lending sort of perspective, indirectly, we've got the operating income and the operating expenses that generate the NOI that will ultimately be there that will decide what the ultimate permanent loan is. When you think about all those various categories, maybe just highlight beyond, increases in hard costs, where when you're updating up the forecast, you're seeing the greatest changes.
Yeah, I think it's as far as the greatest changes, I think timing is one of it's kind of like a twofold issue, right? It's timing dictates when you're incurring the cost and when you're going to finish. And so when those hard costs increase, you need sources up front to cover those increases. Some of the other areas that we're kind of seeing the greatest shift would be NOI, and obviously that directly impacts your available cash flow. With interest rates kind of increasing, there's going to be some more restrictive debt service potential requirements. I know the SCRs, I think are, they're starting to creep where you need a higher threshold, especially for transactions that there's way more volatility in the operations, such as hotels, the hospitality industry. So I think in that context, available cash is key right now, because other than once you solve the source problem, just because you maybe went over budget and you received additional equity, that additional equity doesn't always translate into a change in your cash flow assumptions. And so that change in cash flow assumptions is directly impacted by external forces such as interest. And that's the elephant in the room in the current environment.
No, thank you for that, because I definitely seen a number of developments as of you where, from a net operating income perspective, there's a or I should say from a permanent financing or takeout financing perspective, there's like a double whammy in that net operating income isn't as strong as initially projected, certainly because projected operating expenses are rising and operating income might not be rising quite as much. So there's less net operating income. As if that isn't bad enough, you then have, if you don't have a permanent loan fixed rate takeout already in place, and that interest rate's rising, then the net proceeds you can generate. And even then, it's not just the interest rate that's going up that's causing you to not be able to borrow as much on a lower NOI. It's also, as you were mentioning, the debt service coverage ratio is rising because of concerns about a coming recession. So so maybe I shouldn't say a double whammy, I should say a triple whammy. The combination of lower NOI, higher interest rates, and more conservative debt service coverage ratios. And I'm sure our listeners are going, well, really it's a quadruple or quintuple, or as they identify other issues in that amalgam of matters that ultimately affect the amount of the permanent financing. So we've discussed the importance of more frequently updating financial models. We've talked about some of the common errors developers should be mindful of when putting together their initial performas. We've also discussed the benefits of more frequently updating financial models to identify issues or opportunities sooner in the process. So you can address them and have more runway to address those issues. I thought I'd maybe open it up now more broadly and ask what are the related tips or recommended practices you have for historic tax credit developers.
Yeah, and I think there's obviously this is not the all-inclusive list here, but I think these are some that I think I found very helpful and kind of set the table for going forward, and not just in the transaction at hand, but future transactions that maybe a developer is just kind of starting off. They've done one or two deals, and they're looking for a way to kind of just maintain efficiency as they have more deals to monitor as well as create new deals. So I think one of those things which we've touched on today is just extensively discussing and assessing your budget. Obviously, the more deals you go through, the better kind of sense you'll get of where we should fall in that initial run of your pro forma, you know, and also doing that as early as possible and talking to someone as early as possible too, because if you come in with an estimated capital stack that has some inconsistencies in the assessment of QREs, you may have another problem that you didn't think you had before you talked to the professional. So I think this will at least assist in giving you a best estimate. Now, granted, it's an estimate, but at least you're kind of contemplating the the impacts on HTC equity. And when you have a federal and state HTC transaction, this impact is even more compounded because now you have, for every 10% error you have on the federal QRE, you have a 10% error on your state QRE in most likely that situation. So double the impact on one assumption. And that's a lot of dollars that could be left on the table potentially. So early and often discussions on the budget, and then also, trying to get as soon as applicable a construction timeline that, can be relied on. Because I think that's going to set the tone for interest costs. It's going to set the tone for how much, and how often you're going to need to potentially put equity in the deal. Like I said in the beginning, developers are going to be usually required to kind of upfront their capital at closing, but understanding the placed in service timeline has a really big impact on that assumption. If you're already getting a construction timeline from a contractor that says, December 1st, that's one to keep an eye on because obviously that can either move forward, which is unlikely, but I'll also, go beyond that year end. And, as long as your investor understands that's a possibility and they're kind of building that into the pricing, that's something just to keep your mind on. Additionally, itemizing costs. I know we kind of talked about that. Itemizing the budget as much as possible, trying to isolate the big ticket items that, maybe someone may have questions on, like such as enlargements or, hey, we did this big rehab of the sidewalk outside. Somebody would need to make sure they are excluding that from the overall QRE assessment. And then I think pre-closing, you know, establishing a record keeping system that, is going to work for not just the developer, but, as they continue through the draw process, the lenders are going to want to take a look at all the records that are kind of within that draw. And I found that the Smartsheet, which is a pretty inexpensive tool, helps in kind of making that process more efficient. Lenders can have access to it. The sponsor can have access to it. Novogradac can access to it. And it kind of helps keep track of where things are and, without having to kind of dump all the accounting records and have someone access to your internal records. Those are processes that I think are just going to be extremely beneficial. And as you progress towards the cost certification phase, which, you know, there's there's no wrong answer to when you should start that process. Earlier the better. That way you can work through any hurdles that you may have, and that way you can benefit from the HTC equity when you really intended it to come in.
Right.
So I think those are just some high level items, but I found that the record keeping system makes the whole process immensely efficient and allows the equity to go as modeled.
Great. Thank you, Dave. And I will share your contact information in today's podcast show notes, so listeners can contact you directly with any questions. They can also reach out to either one of us by sending an email to cpas@novoco.com. Please do stick around to the end of our episode for our off mic section. We'll get to ask you for some fun recommendations and words of wisdom. To our listeners, please be sure to tune in next week when my partner, Tabitha Jones, guess I should say our partner, Tabitha Jones, will be joining me for another episode in our So You Want to Be a Light Tech Developer series. Tabitha, we're here to talk about placed and service packages for low-income housing tax credit properties. We'll discuss how the placed and service package differs from the initial application package. We'll discuss what's involved in the placed and service package and discuss some of the differences for those packages for 9% allocated low-income tax credit versus 4% bond finance transactions. And there'll be other topics we discuss as well, including areas that we find can often trip up developers when they're submitting those place and service packages. If you're an affordable housing developer, owner, or considering some other role, you want to be sure that you tune in. And if you have any questions you think we should cover in that episode, please email me at cpas@novoco.com. So now I'm pleased to reach our off mic section. So Dave, one of my common questions, sort of a theme in my off mic section, is work-life balance. And it's definitely something that I continue to work at. I won't say struggle with, because it's something that I am very mindful of, but I always want to do a little bit better. So I'd ask you to share one of your favorite work-life balance tips.
Yeah, it's a good question. And sometimes you have to kind of think about it. You're like, well, what do I do? Because you kind of you get in that routine, right? And you're just like, well, what do I do that kind of sets that apart? And when I kind of think about this question, I'm like, well, kind of growing up, it was do what was fun. Like for me, it was sports and playing baseball and studying those kinds of things. So this year I made sure I joined a softball league. Now, the hard part is staying healthy and not getting injured. But that's also one of the great things, is just getting involved in something that, allows you to kind of separate the day to day from, something you've done in the past that made you happy.
Well, great. I like that. And it's been a while since I've been in a softball league. I'll have to give that some consideration, but I'd love to go off on a tangent talking about baseball. My sons play baseball. My daughter plays softball, but I won't do that. We're definitely a stick and ball family. But my second question is, what's one of the best leadership lessons you've learned?
Yeah, I think that's obviously there's many great answers to this. For me, I think leading by example has been one of the biggest ones that's always kind of called to me, going back to kind of our sports discussion here, kind of being a leader on a team, kind of transitioning that mindset to, professional life, right? You have a team kind of leading by example, showing them the way. I think that's one of the things was instilled in me by my dad, big team leadership proponent. And, I think that sets the tone for everybody, right? And kind of showing the path is what I think is the right way to do it, and doing it the right way too. It's not just getting it done. There's a right way and a wrong way. Yeah,
No, I appreciate that very much. I myself, when you say that, I just think you should expect of others what you don't expect of yourself.
Right.
And leading by example is all of that mindset. So I appreciate that very much, and big believer in that. So I appreciate you sharing that. Let me just say thank you again, Dave, and great job on your inaugural Tax Credit Tuesday appearance.
Thank you. I look forward to many more.
Hopefully it is the first of many. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.